Hello, everyone. Good afternoon. Thank you for joining us today. We're waiting for a few more people to join. We'll start the webinar in 2-3 minutes. Thank you. Good afternoon once again. Thank you for joining. I'll just share my screen and we can start the webinar. Just give me a second. Are you able to see the screen? Okay, I'll start. So as part of today's True Blue webinar, we just wanted to give a sense of the US tariffs and how it will have or if it will have an impact on India and within India specifically True Blue's universe, which is Nifty 50. So that was the purpose for this webinar. Uh, get started. So US tariffs. The US has announced a 10% baseline tariff on all countries effective from 5th April and reciprocal tariffs effective 9th April on 180 countries for unfair trade practices. Was it expected? Yes, but why did markets fall? Right? US markets corrected more than 10% post the tariffs. So just yeah. So the US markets corrected more than 10% after the tariffs was. In fact, the first day there was no market reaction, and then from the second day onwards, market absorbed the impact or the intensity of these tariffs because going from 10% to 25%, and with some countries at 50%, higher than 50%, was too much for market to take. So that's why it got priced in steeply after that. And given the pressures on US bond market, the Trump administration had to pass these reciprocal tariffs for 90 days. But the reason they gave was that it will allow countries to negotiate and sign trade deals. But I feel that they were kind of, they did just. Can you hear me now? Please drop a message if you're able to hear me. Okay. So I'll continue. I'll just start. So the US had announced 10% tariffs, which was then increased to much higher rates for each country, varying. Let's say for India was 25, most other country, many other countries at 50% even, and China even at 100%. Were the tariffs expected? Yes. But why did the markets fall? Because the rates were more than what the market had anticipated or expected. In fact, the first day after the announcement, there was no reaction from the market. Uh, and only in the second and the third day, market started pricing it in. So why did the market, or why did the US Trump administration pass the tariffs? Because of two reasons. The reason that they're stating is that it will allow this pause period will allow countries to negotiate and sign trade deals. But more importantly, their bond market started taking a hit, right? Japan, China, all of them were selling US treasuries, which was creating a pressure on the US treasury yield. Okay. And that's the major reason I feel that they had paused. Of course, they had to give some time to the countries to negotiate. Just check again. Okay. I don't know why some of you are able to hear. Uh, I can hear clearly. Okay. I don't know why Subha is not able to hear. I would request you to sign out and come back again because some of the others are able to hear clearly. Thank you. Thank you for the feedback and going back to the presentation. So what is the impact of these tariffs? Uh, by country wise. Okay, so our impact is only just 2%. Only 2% of our exports go into US, and that's why we are kind of resilient. Our market is kind of resilient post tariff implementation, and so was it coming? Were people able to predict these things? To some extent, yes. If you had read some of the global economists or even some investors, they were pointing to this. They've been looking at it for some time now, because this is not something that is happening like last year or this year. This has been happening for a while now. So this is the best indicator. That is number of industrial policies globally across countries, right? So every country wanted to protect themselves in terms of giving protection, in terms of, let's say, subsidized land, subsidized electricity, maybe wage tax credits, or any labor reforms, and even in terms of capital, right, subsidized interest rates. So there have been a lot of industrial policies across the globe, and that's been going up significantly in the last few years. So this was anyway coming. Of course, US had put itself into a difficult situation for itself, but we don't. I don't want to get into that. That will be a different subject altogether. But industrial policies have been going up. All countries were concerned about their own security, their own job creation, and so on. So in the just after the First World War, or around the First World War, the tariffs had started going up globally, especially the US tariffs, because the reasons then were different, the reasons now were different. But we can see that after 2020, or after Trump's first term, it went up slightly, and now it has gone back to significantly higher to 25%, which is the peak of the last century. That is the early 1900s, was when we had similar tariffs. And if you see the Smoot-Hawley treaty that was signed then, that was withdrawn in just, I think it was a matter of 4 years. But by the time the tariffs were withdrawn, the global economy had already taken a hit. Yeah, so this tariff that happened during the Great Depression reduced global trade from 5.3 billion then to 1.8 billion within a span of just 4 years. But today, US imports account for 14% of global GDP, right? Three times higher than 1930. So if the tariffs were to sustain, the impact will be significant, at least compared to the previous depression. US might go into recession and so on, but we can't say anything for certain now, because this is an evolving situation, and we don't know how or what the Trump administration will do and how China will react to it. We can only see where we are at and how we can protect ourselves. So India. So India's merchandise exports, that is, so if you can separate exports into two. One is merchandise, the other is services. We're not looking at services because, of course, there are no tariffs on services, but they'll have some second order effects, which we'll talk about in a bit. So India's merchandise exports contribute only 11% of our GDP, one of the lowest among the emerging markets, which limits the impact of our or any global trade slowdown. So, like if you see at the bottom right, India is at 11%, and only UK, Brazil, Japan are similar to us, whereas someone like China is at 2x of our uh, goods exports as a percentage of GDP. And there are some countries which only rely on exports, for example, Thailand, Malaysia, Taiwan, and so on. So we are relatively safe, I would say. And the other thing is that, unlike other countries, India has refrained from retaliating. So thereby we'll benefit from a lower increase in import tariffs. Of course, after this 90-day pause, there will be some tariffs, maybe on all sectors or on some sectors, depending on how our the bilateral trade agreement works out to be. JD Vance, the VP, was in India last week to discuss the reference terms, and their secretary said that the reference terms have been agreed upon, and probably when Trump visits India later, that the trade agreement could be signed between India and US. Another thing that's going in favor of India is the private final consumption expenditure. So let's say 100 of the 100% of GDP, we've just seen that our merchandise exports is only 11%. So the major chunk, where does it come from? It comes from expenditure, which is our own consumption. So it's 60% of GDP for us, whereas it's 39% for China, because China is heavily reliant on exports. So we are less reliant on exports, and thereby insulating our economy from global trade disruptions. And India, our balance sheets are very healthy, be it corporates or be it banks. So there aren't any major systemic risks in India. Of course, there are pockets where you're seeing NBFCs, especially microfinance focused NBFCs, reporting higher credit costs and slippages. But I think we're close to a peak even in there. But even broadly or overall, there are no major systemic risks to the country because our non-financial corporates debt as a percentage of GDP is only at 52%, whereas China is already at 139%. And this is banking systems NPA in the last 17, 18 years. We peaked at 11.5% gross NPA in FY18 because that's when you see a lot of defaults, a lot of credit costs and slippages for banks, and we were starting to see NCLT cases, bankruptcy cases going through the roof back in 2018. And from then on, we have come down to 2.6% gross NPA, which is same as what we had during the previous capex cycle, beginning of the previous capex cycle, that is FY 2005 to 2008, 9 times, after which the NPA started rising once the lending cycle picked up. But we are nowhere close to that now. And government debt is also under control for India, as the government has been in a serious fiscal consolidation phase over the last 2 years. Just after COVID, we increased our fiscal deficit because the government had to give some stimulus to the people after COVID. But in the last 2 years, government has focused more on fiscal consolidation, that is to bring down the fiscal deficit of India, and thereby our government debt as a percentage of GDP is within stable levels and not very alarming like that of, say, US or even China. We are slightly lower than China. So Indian households also witnessed a jump in debt levels post COVID-19 because everybody YOLO'd their bank savings and they started borrowing more to drive consumption. But RBI's timely actions in the last couple of years, where they increased the risk weights for retail or to bank loans to NBFCs, all of that was curtailed through certain actions. So, but even otherwise, our household debt as a percentage of GDP is at 42%, whereas China is at 60%. So there has been research papers by economists stating that only when the household debt as a percentage of GDP crosses the 60% threshold is when it starts hitting or it starts cutting down the disposable income available for the household. That means the EMIs will become bigger than, or it will wipe out all your disposable income when household debt as a percentage of GDP is greater than 60%. So we still have that leeway or the headway to increase our household debt at the aggregate level, which basically means we can borrow more. So if we split India into rural and urban, for rural, which is mostly agri-heavy, agriculture's contribution, agri is typically dependent on the monsoon. So that's contributing 16% to India's GDP, the highest amongst major countries. Even China is only at 7%. We are at 16%. So everything 16% of our GDP is dependent on the monsoon and the agricultural output. So rural economy, which is because of factors that we just spoke about, is relatively insulated to global cycles, and it's on the revival path. If you see the latest growth in Q3 FY25 was 5.6%, whereas in the previous year it was much lower. It was almost close to 1.5%. So, and we have kind of bottomed out when it comes to agri sector growth, and we are ticking up again, inching up again. And our wage growth had taken a hit because of inflation post-COVID. So our real wage growth was negative, in fact, in FY23. So nominal growth minus inflation is your real rural wage growth. So that's a proxy to, of course, disposable income and the spending capabilities of the rural India. And now that's inching higher, and that's going to be the highest as per estimates in FY26. It's clearly that rural India is coming back after a dull period. So what about urban? So urban India has been weak if you see the some of the FMCG numbers. But we've got two potential drivers for consumption. One is the income tax reduction. The slabs were more benefits were given for the slabs, and no income tax till 12 lakhs. This will roughly benefit roughly 2 to 3 crore Indians. That is roughly 40 to 50% of the total taxpayers in the country. With so they'll have going forward, they'll have somewhere from 25,000 up to 1 lakh at the peak for the peak slab. So this is the incremental savings that they'll have in their hands, which either they can save or they can invest or they can spend, right? So this total 1 lakh crore that the government forego to pass it on to the Indian citizens. So that will come into the market in the form of savings, investment, or consumption. That's one. The second big driver, bigger than the first one, is the M2M gains on our gold, be it the gold physical assets, it could be coins, bars, it could be jewelry, or some of them hold gold ETFs. So whatever it is, Indians are enjoying or sitting on a 50% M2M gain on gold. They can use this in two ways. Gold loans, if you see Chola recently launched, they announced that they're entering gold loans, right? So gold loan driven consumption, where people go and mortgage, they pledge their gold to get money, to borrow money, and then spend it. That can go up, or some of them can sell their gold and buy, be if it's in the form of bars or coins, you can buy and go and buy jewelry. So there'll be some consumption boost from these MTM gains that the Indians we are sitting on in the last couple of years. Sorry. So I would ideally like a production-driven consumption boom. So what do I mean by production-driven consumption boom? So what happened in the previous cycle was, let's say between 2005 to 2011, 12, we put up a lot of capex. We built industries. We set up a lot of plants. We created jobs, and thereby we created more income for ourselves, right? So, and that drove the entire consumption demand of the last decade or 10, 15 years. And we have to go through such a cycle again for us to have a production driven consumption boom where we'll create more jobs, more income, more salaries, and then more spending, more consumption. So that's more sustainable. But given where we are currently from a global perspective, I would take these two drivers too. There's 1 lakh crore from income tax and the interim gains on gold till there is clarity on tariffs and economies come back to normal. So we've spoken about US. So we don't know when we'll sign the trade agreement, what will be the final tariffs. But the other risk is, of course, China. What can China dump uh, globally, because they cannot sell uh, to US at the rates that they used to previously. And this was visible even after Trump's first term, where he levied tariffs on certain products like metals, be it aluminum and steel, and even China being clever, China being who they started diversifying their exports. So share of China in US imports came down from a peak of 21% to it's almost 13% now. So they've cut down what they were selling to uh, US. Now, given the second round of tariffs and significantly higher tariff rates, absolute rates, so what can China dump globally? So this is the list of top 10 imports by US from China. And you can see top of the list is mobile phones and computers, but they can't be dumped in India because we have our own PLI schemes running. So government is protecting these two sectors, and it is cognizant of the fact that this is a job creator because the entire EMS industry that has boomed in India in the last few years is because government did PLI, announced PLI, and protected this industry, right? So that we will not see dumping. Maybe the low-level phones or the feature phones might see dumping from China, but I think we are the Indian ecosystem is stable at least in the larger ticket size mobile phones and computers. So where could the dumping be? It could most likely be in electric and industrial equipment. Second, clothing and textiles for sure. We're already seeing that certain grades of yarn are being dumped in India by China already in the month of April. And third could be household appliances and goods. But what could happen is Indian companies can partner with Chinese players for household appliances like Reliance apparently is in discussions with her a consumer durable brand for FDI or for joint venture in India. Right, so these three segments are the top ones where we could see a lot of Chinese products flooding the markets and affecting our producers locally. So India coming to Nifty 50. Right, so this is the latest sectoral weights within Nifty 50, and I've just tried to see where the impact is the highest. So I told you about second order effects. I feel that IT will have a significant or at least high impact because if US goes into recession, let's say because of tariffs and all, US companies take a hit, and thereby the salaries, the spending of US companies take a hit, which means IT, which is mostly discretionary spending by US corporates, that will take a hit in a recessionary environment, right? So IT will have a very high impact. And next is oil, gas, and consumables. So we don't produce a lot of oil and gas. We import them, we refine them, and then use it. So the oil prices will have an impact. It could be positive also, right? Let's say oil prices keep falling, then we'll be net beneficiaries. Automobile and auto components, we don't have large exporters. M&M has, within Nifty 50, M&M has some exports. Bajaj Auto has some exports, right? So that could be impacted if China dumps in the rest of the world markets, not necessarily US, but rest of world markets. Healthcare, it's exempted for now, which is pharmaceutical, pharma, drugs, but tariffs are expected. But some say that tariffs will be there on patented drugs and not generics, because there's no point levying tariffs on generics because US cannot match the cost of India or China. And even on patented drugs, so US healthcare market works a bit differently. There are intermediaries between the patient and the hospital or the pharma company itself. So these intermediaries earn the biggest chunk of the drug, apart from of course, the innovator pharma company. So the government should cut down on the intermediaries earning from the patients there, rather than putting tariffs on the drugs or the APIs of these drugs. Metals and minings, of course, China is 10x, or at least now I think we are roughly 6x of uh, China, 6x of India. So any incremental, let's say, 1 billion tons, or not 1 billion, 1 million ton of steel is diverted to India, that will have an incremental impact. We're already seeing dumping from China. So this will be more of a marginal impact. Of course, consumer durables, we did talk about. We are still importing a lot of stuff from we're still importing a lot of stuff from China because, like, for example, we don't have compressors, AC compressors, uh, enough capacity in India. So, government is again working on cutting down consumer durable dumping from China by uh, through PLI schemes. For we have now PLI for copper tubes, for compressors, for all elements of AC and the other consumer durable items as well. So I feel that the impact will be medium. In fact, if we can sign up with some of these Chinese companies for technology, that'll be great for us. Capital goods, again, medium. In the Nifty 50, we don't have much exposure to capital goods, but at an India level, we will have impact like we saw in the previous slide. Non-electrical equipment, US was a big buyer. Now some of that supply might reroute to other markets. But if you see, almost 62% of Nifty 50 will have very low impact and most likely only a second order impact. Let's say there's a global slowdown. India so far hasn't seen a recession as such, except for COVID, of course. So this is most likely be a second order, and that too very low impact if we have a global recession. So they'll not be impacted directly, but they'll be impacted indirectly. Let's say there's a global slowdown somewhere else, and that flows through trickle downs to India. That's how the 62% of Nifty 50 is resilient or insulated from the global tariff situation that we see. So if we double click on each sector, so this is pharma. Pharma is significant because the absolute size. For example, for Sun Pharma, 68% of its sales are exports, of which 33% is to US. Dr. Reddy's is at 49% of sales to US because their export percentage as a sales is 83%. Cipla. So these three complete the trifecta, pharma trifecta within Nifty 50, Sun, Reddy's, and Cipla. All of them have exposure to US. Of course, there are other pharma companies as well which will be impacted if there are tariffs both on generics and patented drugs. Patented drugs, if there are tariffs, CDMO companies will be impacted. For example, the likes of Syngene and TVs. But if generics are impacted, our typical Suns, Reddy's, and Ciplas will be impacted. Auto, like I said, not a significant part of our exports. For example, M&M, for M&M, it's just 4% of sales, and within that, US is less than 1%. But let's say the indirect impact on auto and why I feel it is a medium risk is because, let's say, as part of the bilateral trade agreement that we signed with US, what if US forces its hand and ask India to reduce the tax on imported automobiles? For example, for a completely built unit, CBU, we have 120% tax. That was reduced recently when Modi had recently visited US. But what if it was brought down to zero? Right? It could happen. So that's a risk. Then your Harley Davidsons will become cheaper. Completely built units that are imported usually your uh, super cars from the US or anywhere will become cheaper. So there will be more competition for an Indian OEMs, and not just US. Let's say, what if Europe signs a BTA with us, or even UK signs a BTA with us to reduce the import duty on completely built units. So that's a risk for auto. Capital goods, like I said, not much within Nifty 50, but there are companies like LG Equipment or some EMS companies like Avalon which have significant exposure. L&T has 16% exposure, but this is not capital good per se. They have two IT subsidiaries, LTTS and LTI Mindtree, which have exposure to US. So that will take a hit if the discretionary spending in the US comes down. Metals, so because of the Trump administration's tariffs in the first term, there was a rebalancing of steel uh, trade globally that has already happened. For example, China used to export 3 million tons of steel to US. That has come down to zero point 0.5 million ton as of 2024. Maybe this zero point 0.5 million ton might have to go to some other country. It could be India or anywhere else. So the marginal impact for India is zero point 0.5 million ton, worst case. But some of this zero point 0.5 million is specialty grade steel. So that I don't think US can stop buying it. Probably they'll buy some of it from Canada, Brazil, and Mexico. So some of it might come to India. But India is already at a run rate of roughly, I think, 8-9 million tons of importing Chinese steel. So zero point 0.5 on a base of 8-9 million is okay. There will be impact, but that will be very marginal. So summary, so India is not decoupled from global growth cycles, but it remains highly resilient to global recessions. Like I said, we have seen only one recession so far, which is a full blown out recession. That was only during COVID. So India is one of the most stable macroeconomies. We have low export dependence, only 11% of GDP, and within that, US is only 2% of GDP. On say how to calculate the impact on our GDP. So on this 2%, you live by 10%, that's 0.2%. So the impact on our GDP will be 0.2% if it's 10% tariffs. If it's higher, it will be slightly higher. But we'll not take the entire hit. Let's say half of the hit is taken by the US citizen or the US the buyers in the US, right? The rest of the half we'll take. So worst case, it could be 0.2, 0.3% hit on our GDP. Our primary concern with India has been, or it was, the lack of margin of safety in valuations. But given the correction that we have had, I think we are fairly comfortable uh, with the valuation, some of the pockets, not across the bucket. And India could also benefit from this entire thing because China plus one, which is on paper till now, is actually happening for real on ground. Apparently, a lot of textile companies in India are seeing much higher inquiries from US companies, and they want it done immediately, like in the next few quarters, in the next 90 days. Chinese FTA in India, I think it's time for us because in the Indian corporates, they don't have, they have very good balance sheet. They're sitting on cash. Banks have very low NPAs, but the private corporates are not spending. If private corporates are not spending, it makes sense for the government to let the Chinese come here and spend, put up capital. But I think if you read the recent reports, it's very clear that Indian government is okay if there is technology transfer. Otherwise, Indian government doesn't want Chinese FDI in India. So for sectors where we lack expertise, I think the Indian government might allow Chinese FDI. We've already seen that in a couple of auto ancillaries. I think Gabriel Group signed one, and before that, there was another group that uh, signed a Chinese FTA deal, which got approved by the Indian government. So that's the summary. So that brings us to the I thought way, our investment philosophy. We have a very long-term focus. We don't trade. Our minimum holding period is 3 to 5 years. Our churn is very low. It will be less than 0.1% or approx around zero point 0.1 to 0.15. Non-consensus investing will not go where the market is. We're not contrarian for the sake of being contrarian, but we want to be in places where there's no consensus. And we have a very bottom-up approach, although the entire discussion today was top-down, but that was just to give you an overview. Even if you go bottom-up, you'll get to the same thesis that India is completely, not completely, at least to large extent, insulated from the global uncertainty. High focus on risk management. So True Blue, which is our large cap fund, we have four funds. Within that, True Blue is our large cap fund. And that focus on capturing mega trends, be it the India growth story or be the global champions. Global champions could be IT, pharma. We are very overweight on pharma as we believe US cannot make drugs in their shores because they can no way match the cost of Indian companies. So it'd be foolish for US to levy tariffs on pharmaceutical drug imports. So TrueBlue captures both these mega trends. 100% pure large cap, high active share. See, for example, some companies, some sectors even within the Nifty 50 have very low exposure. For example, capital goods or construction will have very low exposure. Insurance as a percentage will have very low exposure. So we can play aggressively within the universe of Nifty 50. And like I said, we have very low churn. We buy and hold typically. We have both options. Zero fixed fee is purely variable. We also have a fixed fee option. Good corporate governance, strong leadership teams with track record of execution. For example, we are invested in all banks in Nifty 50, but we have not even looked at or even touched IndusInd. That's because both one and two were missing in IndusInd Bank. We invest only in industry leaders. We look for high ROCE and zero or low leverage at reasonable valuations. So broadly, I don't want to get into each of these pillars, but we focus on all these four to construct our portfolio. This is purely a large cap fund, and our philosophy boils down to two things. One, how much do we fall in the market correction versus benchmark relative to other funds, and what is our performance? And in terms of drawdowns, even before this correction, where we have beaten the benchmarks, even in the last previous correction, we have significantly performed better than the other funds. For example, in the Russia-Ukraine war drawdown, our portfolio TrueBlue fell only 12%. Everyone else fell anywhere from 14 to 22%, with Nifty 50 falling 17%. And the next drawdown was in March 2023. Again, TrueBlue fell minus 5%. That is half of what Nifty fell. Nifty 50 was down 10%. And we were better than the other large cap funds within the category. So our endeavor is to generate 200 to 300 basis points over the benchmark. Let's say if Nifty does 12%, our endeavor is to generate 15% returns over a 3-year rolling period. Product suitability, this is TrueBlue is perfect for first-time investors, or if you're relatively new, if you're just in your first or second or third year of investing. I think TrueBlue is the better product for you. Or if you're closer to retirement, you have already retired and you have a retirement corpus, this is the product for you. This also caters to family offices and institutional investors. So it's a resilient, high quality portfolio that should be part of your core wealth portfolio. I thought is headed by Mr. Shyam Shekhar, founder and fund manager. He's assisted by Mr. Gia Balaji for TrueBlue. Balaji is also the head of research. This is the team. We have a 10-member research team. We have a 6-member strategy team, which works. We try to build bespoke portfolios, customized portfolios for all our clients, and that's done by the strategy team. And like I said, we have 4 funds. Solitaire is our multi-cap flagship fund. TrueBlue is a large cap fund. Riddhi is a small cap fund. And Sphere and Neo are multi-asset funds where we invest in gold, silver, Nasdaq, China, and so on. So one is drawdowns. The second is, of course, performance of the fund. And if you see the 6 months since the correction started from October to March, we are down 7% roughly. Nifty 50 is down 8.5%. And in the last 1 year, we have managed to get a 4% alpha, almost 3.8% alpha over Nifty 50. And even across 3 years, you see a good, decent alpha. or the benchmark. Key terms: minimum 50 lakhs as mandated by SEBI. We have both fixed fee option and a variable fee option. Thank you that we've come to the end of the webinar. I would love to take questions. If you have any questions, please feel free to type it in the chat box. Thank you. There are two questions already. India, how will India competency improve due to differential tariffs on India and China? I think we'll have to get down sector by sector to arrive at this. For example, let's take textiles, right? So we have 25% tariffs. Vietnam, Bangladesh have significant, almost I think 45 to 55% tariffs. So it's not just China. Now our competency versus even other smaller players, Vietnam and Bangladesh, has gone up significantly, right? And that's why I said a lot of textile companies are seeing inquiries that they're they want to sign a deal or win orders in the next 90 days itself, right? So that's the kind of inquiries that textile, not just textile, this is across the board. We're seeing wherever, let's say, China, Vietnam, Bangladesh had a advantage or they were ahead of us. So there, India can start gaining market share. Of course, the opportunity is there. It's up to us for our entrepreneurs to go out there and win the demand, right? It's not like it will be served to you on a plate. What government policies changes is expected to reduce the tariff impact? So there are, see, this is very, like I said, it's very evolving, and every day there is something or other happening. For example, there were news articles on US wanting to dump its agri outputs in India. For example, US is a large producer of maize or corn. Okay, and let's say if Indian government allows US to export corn to India, what does it mean for our Indian farmers? So whoever is growing corn in India will take a hit because a lot of industries rely on corn. It could be poultry because poultry uses corn as a feed, and then there are companies like Gujarat Amala Exports, uh, which process corn to make derivatives like starch. So a lot of industries are dependent on maize or corn as a raw material. So what if Indian government allows uh, US to export corn to India? But that's unlikely because then BJP might lose votes or elections, at least from the farmers who grow these crops. So it's very tricky to second guess what the government will do. We just have to wait for the final terms or the final contours of our bilateral trade agreement with US. More simply, to reduce the deficit that we have with US, what we can do is we can buy more oil from them, we can buy more gold from them, we can buy more gas from them because US wants to drill baby drill, right? So they will pump out more oil and gas, which we can buy their coal, or even there were talks that we can buy their defense equipment. For example, India is looking to buy a few jets. We've recently signed Rafael Marine, but it's for Navy. But our Air Force also wants, apart from the stages that we're doing, our Air Force will either go for an indigenous advanced combat aircraft, or they might buy a ready-made military jet from either Russia, France, or US. So US has Lockheed Martin, US has Boeing's. So we can buy any of their jets to offset the trade deficit that we have with US. So what will we buy to bring down the deficit? I've given the possible scenarios, but we'll have to wait for the final terms of the PTA. We have looked at a macro level, now thinking more on a micro level. For domestic facing companies, especially FMCG, HUL, Colgate, Gillette, considering these are mature growth companies, what is the perpetual growth rate and discount rate you would ideally use? Wow. Can you talk about the same for auto, both for four-wheelers and two-wheelers? So using the same growth rate or the terminal growth rate, or you're calling it perpetual growth rate, for all companies will not be a right factor. Like, for example, Marico, which is also an FMCG company, is growing at a different or a much higher rate than the rest of the pack. Like you said, we are a mature market in some of the categories that you have mentioned. It will not be right to use a single terminal value growth rate for all the companies in the sector. Can you talk about the same for auto? See, auto, so Kenneth Andrade, who's also a fund manager, he gave a very simple thesis for Maruti. Okay, so they're going. So he has two. It was just a two-liner thesis. One, the ticket size is going from 6 lakhs per car to say 12 lakhs per car, because we are going from a entry-level car or a hatchback to a compact SUV, right, or a small SUV. So the ticket size is doubling. And two, Maruti is looking to double its capacity in India. It could be driven by Suzuki, or it could be that they're looking at the export market now in a huge way, because they'll have more, they look at India as an export base for Suzuki, right? So that could happen. And if you see Mahindra and Mahindra's latest update, that was crazy, right? So when Maruti reported a flat growth for the month of April, M&M reported a 28% growth in its passenger vehicle, because all of it were SUV. Whereas for Maruti, it's a mix of entry-level cars and compact SUVs. So again, even for auto, you cannot do a same growth rate for all the companies. So that will be, you'll have to be company specific, because even in auto, it's linked to launches. Whenever a company does a launch, it will have a good 2 years. Or let's say they're looking at exports, that could be a growth driver. So you'll have to be very company specific. Once we reach threshold investment in M2W, can we shift to True Blue? Of course, sir. So you will have a discussion with your RM, right, at every milestone that you reach within M2W. And at each milestone, what is best for you will be suggested by our RMs. And if you're new to markets, and if you don't have any experience in markets, or if you're closer to retirement, or if you're already retired, I think True Blue should be the first product that you should shift to within our PMS when you reach the threshold of 50 lakhs. Please explain the fee options. So we have two fee options. One is, first option is 0% fixed fee. We don't charge anything. It'll only be linked to your performance. So the performance fee is 20% of profit share above a hurdle of 6% with no catch up. Whatever profits that you generate, your portfolio generates, beyond 6%, we'll take a share of 20% on that. Second option is a pure fixed fee, 1% fixed fee, because this is a large cap fund, and we wanted to be competitive in the market. The fixed fee is just 1%. Okay, following the question, being company specific, would you then take the average growth rate, say 5 years, to determine your approach for the next question? And the two-wheeler space, do you think there will be disruption when Hero, Harley, Bajaj, Triumph comes to market, especially now that Harley is considering? See, I think Harley, the price points will be much different, but I don't know why you're so specific about growth rates, because every sector is cyclical, and you'll have to you'll maybe at the bottom of the cycle, you can assume that growth rates will mean revert. There'll be good days ahead. For example, we started buying Bajaj Auto in 2022 and 2023, and we have seen that play out very well because post-COVID, there was a mean reversion in, of course, the first 2 years was driven by cars, passenger vehicles, and within that SUVs. But we saw growth in Bajaj Auto in subsequent 2 years, that is 2023 and 2024. Right. So I would maybe we can take this offline on why you want to uh, project an average growth rate and that too for 5 years. Like you said, within two-wheelers, let's say Hero is operating at a different cycle because they're towards the economy. Bajaj is slightly at a premium. Royal Enfield is premium and luxury. And of course, on the impact, it's still early days because we don't know what the brand perception of because Campa is doing very well, probably because of the price point. Although if you remove the labels and you keep a Campa Cola and Coke, you wouldn't be able to tell the difference. But the costing of Campa is letting it gain market share. So probably even if Java wanted to fight it out with neck to neck with Asia, but maybe the price point didn't work out well, and that's why Asia continued to do well. So you never know with a price conscious customer, especially we Indians are price sensitive. So you even Harley, they might not even after the tax cuts, they might not uh, price it like similar to a Triumph or Java. It could be much higher than even a Royal Enfield. Again, we'll have to do stock specific discussion to get into the details of what is the market, who's the customer, what is the price points that each operate in, what are the CC levels that each company operates in. Maybe you can take this offline. What will be the future of platform company like Zomato and Swiggy? So the first I'll give you the good thing. Good thing is that a customer acquisition cost for, let's say, a typical FMCG brand today is roughly, it could be 30 to 40%. Okay. What Zomato and Swiggy have done is, given the customer base that they have, they've already acquired the customers. Okay, so anything incremental that they sell using the same platform will be very margin accretive for them because they already own the customer. If they could sell anything, that's why they're getting into quick commerce and so on. So what these platforms are doing is they're cutting down the customer acquisition costs, which otherwise FMCG companies they've been struggling with, and now we're seeing a increase of D2C, direct to customer brands. So while they reduce the customer acquisition costs, but given the funding in the sector, looking at the attractiveness, the long-term potential of these platforms in India, there's a huge runway that's left. There's more competition coming in, and it is very difficult to establish if there will be, forget who will get the profit share, but will there be any profit share, profit pool within these players is very different because globally, quick commerce hasn't worked as expected. It isn't as profitable as it was supposed to be. Only in India, it seems to be working. Okay, for how long will this work? How long will the cash burn continue? Uh, I don't think it's difficult for any of us to guess it. And not just regular commerce. The quick commerce is now again everybody wants a piece of that quick commerce pie. So it's very difficult to predict the future. Of course, market has its own whims and fancies. It's giving a certain PE to the profits, but It's very difficult. Thank you for the detailed presentation. Thank you, sir. So what products do you have for small cap? So for small cap, we have a product called Vriddhi, which predominantly invests in small caps, roughly around the 5,000 crore, 10,000 crore, 1,000 to 10,000 crore bucket. So that's the small cap product, Vriddhi. You can reach out to any of our RMs to get an idea of Vriddhi in detail. Understood the growth rate question was more towards mature FMCG like HUL. Thank you, was insightful. Nonetheless, do you work on vocal billion? Thank you, Sai. The HUL, see, you could assume real GDP growth of say 5-7% CE. Population growth is at best 2%. Okay, and rest of it has to come from productivity or increased demand in FM's HUL scales from the existing customers. So I think you can work with 5-7% growth rates for HUL at a broad level, maybe with categories within HUL, because now they're acquiring D2C brands, right? So those pockets will have higher growth rates. Can you speak about PMS products and rules do you have? So we don't have any rules. So SEBI has mandate that any PMS investor, the minimum contribution, the first contribution should be 50 lakhs, and beyond that, the contribution can even be say 1,000 rupees, 10,000 rupees, whatever client wants. Right, the initial contribution should be 50 lakhs. So that's the rule, and we have four PMS products. Today, what we discussed was True Blue, which is a pure large cap product, and our flagship product is called Solitaire, which is a multi cap product. We invest in large caps, mid caps, and small caps. And then we have a pure small cap product, which is called Vriddhi. And then the final product is a multi-asset product called Sphere. In the multi-asset, we invest in gold, silver. Like last year, we were very heavy on gold and silver. We had invested in Nasdaq, and we had invested in China also in that multi-asset product. So these are the four products that we have under the PMS umbrella. Disruption happening in paint and cable segment, how will it move forward? So in this True Blue webinar series, I've done a video on paint sector. I think Shades of Gray was the title of the webinar. You can go to our YouTube channel, I Thought PMS YouTube channel, and you can see all our past webinars as well. We record and upload all the webinars that we do. But to give a point here, see, whenever an industry is consolidated and if the industry has high ROEs for a long sustainable time, it's ripe for disruption. For almost a decade and more, almost 1.5, 2 decades, Asian Paints, Berger, and Axo, they were all operating at very high ROEs. In fact, it was 2x the cost of capital of India itself, right? As in, let's say if the Nifty long-term CAGR is 10-11%, these guys were doing ROEs upwards of 20%. Okay, so obviously anybody outside the industry will be attracted to their industry. For example, who is disrupting these two segments? It's Ultratech and Grasim. Grasim's ROE, if you go and check, or Ultratech's ROE is 12-13%, same as cost of equity, marginally higher than cost of equity. So if they can go to a sector where the ROE is upwards of 20%, because if they enter, the ROE will not sustain there. It will come down to say 17-18%, which is good enough for them, right? It's still 4% higher than their base business ROE. So that's why they're trying to venture. Same with JSW. For JSW, it was also an adjacency because most of the, I think 1/3 of their paint output is consumed by JSW Steel itself for the coated products in steel. And now when given they have this MG new venture that they have for cars, they can use their paints for automobiles also, right? So that was more of a captive adjacency for JSW. But Ultratech again is a more like a forward integration. Of course, they want to tap this attractive market. Another thing is, so Hindalco makes copper. Copper is downstream product is cables and wires, so why not get into it? I think that was the thinking behind them getting it. But basically, consolidation, consolidated sector, high ROE, ripe for disruption. Your view on current valuations in the India-centric business in Nifty 50. I think IT has corrected significantly, roughly around 20 PE. It's the sector usually, I'm not saying it will, but usually bottoms around 17, 18 PE. That would be a good entry point. And banks, I think they're still cheaper than their relative history. So there are pockets which are still attractive. For example, banks within Nifty 50, some FMCG companies are relatively cheap. Of course, there are pockets where some are expensive. At an overall level, we are at 20x 1 year forward. Let's say FY26, if we take, I think the Nifty 50 is at 20x. I think 20x is fair if we maintain high ROEs. Post-COVID, our ROEs as a sector, as a country itself has gone up significantly. We are roughly at 15-16% ROE at the aggregate level. If we can maintain these 15-16% ROE, which I think we should, this 20x will sustain. But if whenever market thinks that this 15-16% ROE will not sustain because of the global trade disruption or recession, we're going to take a hit on growth, and that will result in some operating deleverage. So this ROE of 15-16 will come down to say 13, 14, 12%. Then we'll go back to 17, 18 P at the index level itself. So the important driver for us is margins not rolling over, and we have to maintain our margins. For that, growth has to continue. That's why I said we have been given this opportunity. It's up to the entrepreneurs to go out, get the global demand or gain market share from China, and that will create more jobs, more income, more spending, and then we'll get into this cycle, virtuous cycle. Because today we are roughly at 6.5% GDP growth. Let's say our GDP is impacted by 0.25%. We'll come down to 6.25%. That's not where we should be growing at. We should be aiming for 7% GDP growth. Like I said, 1-2% population growth. The rest has to come from productivity. And our market share as a percentage of GDP is 3%, roughly to 3%. So if we have to grow faster, we have to grow faster than the global demand, gain market share. That's how we can get to that 7.5% GDP. Will Nifty 50 double in next 5 years? Okay. At 20x P 1 year forward. So doubling in 5 years is roughly 15% CAGR. Yeah, should be possible, sir. 50-50, yeah, should be possible. Just give it a minute before we can close. Your take on energy sector. I think we have to spend a lot on energy going forward. Two reasons. One, our own demand is growing at 7-8%. The electricity demand I'm talking about. And I think the next few years we'll go at the upper end of that range, say 7.5-8%. Right. So one, we have to put up capacity for that. Two, if you're going to replace coal with solar, we'll need more of solar because The efficiency factor, uh, let's say, efficiency of coal power plants is 66%. That is two-thirds. The efficiency of a hybrid solar plus wind is just 33%, one-third. So if we used to put up 10 gigawatts of coal previously, we now have to put up 20 gigawatts of solar and wind. So for our own demand, we have to increase our power capacity to be competitive with the global stage. Today, our electricity cost for the industries, I'm not talking about our homes, for the industries is still in double-digit rupees, 10, 11 rupees. But if we have to be competitive, we'll have to move towards solar and wind, which today the PPAs are being signed at 3.8 rupees, I think was the recent auction by SECI. Right? 3.8 rupees is very good for an industry, which is reliant on power for manufacturing. Right? So our share of cheaper power should also go up. Our power demand is also going up. I think the energy sector tailwinds will be there for at least in the medium term. Thank you. I see someone typing. We'll just wait for that and then we can close it out. Thank you. Thank you, everyone. Thank you for joining. Do join us for our other True Blue webinars where we'll be discussing each sector and sometimes company specific webinars also we do. And do go to our YouTube channel to watch all our webinars. Thank you. Have a good weekend. Bye bye.